As we look at the boards on this Tuesday, June 23, 2026, the equity markets are currently closed, which means we are analyzing the final figures established during yesterday afternoon's closing bell. Datavault AI Inc., trading under the ticker symbol DVLT on the Nasdaq Capital Market, wrapped up its last active session on June 22, 2026 at 4 p.m. Eastern Daylight Time at a precise price of 0.3895 USD per share. This represents a downward intraday market movement of negative 4.18%, a drop of roughly 0.017 USD from its previous market position. While the casual retail investor looking at their everyday mobile tracking screens might view this as just another standard volatile day for a microcap asset, the reality beneath the surface tells a completely different story that most people are completely missing. Right after that closing bell rang, the company pushed out a major corporate regulatory filing that introduces a brand new layer of friction for anyone holding this equity. Datavault AI Inc. officially issued over 2.7 million participation warrants to Maxim Group LLC and filed a corresponding prospectus supplement to register the underlying common stock. This move directly threatens existing shareholders with sudden capital dilution, showing that the company is aggressively hunting for fresh liquidity to keep its lights on. Investors who jumped into this name expecting a simple, clean asset expansion play are suddenly forced to confront the harsh reality of a restructuring capital framework. This creates an immediate mismatch between what the general public expects from small-cap technology bets and the actual corporate maneuvers taking place behind closed doors. When people look at the broader technology landscape today, the prevailing narrative is dominated by the massive financial returns seen in megacap names. Retail participants open up their accounts to check Tesla stock, browse the daily performance of Apple stock, or marvel at the relentless upward momentum of Nvidia stock. Because of those massive success stories, the average retail participant enters the self-investing arena with the assumption that any company with the letters A and I stitched into its corporate name will automatically follow a similar parabolic growth trajectory. They see a sub-$1 stock price and think they have found a rare, hidden bargain that will turn a tiny initial investment into a massive windfall. This expectation is fueled by standard internet forums and casual trading groups where high-risk penny stocks are frequently discussed with immense optimism. The reality, however, requires a much more grounded and critical perspective. When you examine the actual mechanics of an online investment in a microcap company like Datavault AI Inc., you are not dealing with a stable corporate giant that has billions of dollars in free cash flow to buy back its own shares. Instead, you are looking at a highly speculative company that is actively burning through its reserves to fund early-stage infrastructure projects. Many individuals who utilize automated asset platforms, such as Schwab Intelligent Portfolios or a standard robo-advisor, rarely see these types of microcap equities in their diversified baskets because the underlying risk profile is far too volatile for a standard baseline intelligent portfolio. For people who handle their own portfolios on independent investing sites, separating the marketing hype from the hard numbers on the balance sheet is the most critical step to avoid permanent capital loss. If we look closely at the recent stock movement for Datavault AI Inc., the sheer volatility of the daily swings is enough to give any conservative investor serious pause. The stock has been trading well below its 52-week high of 4.10 USD, drifting closer to its 52-week low of 0.2512 USD. During the last session, the trading volume hovered around 12.62 million shares, which is significantly lower than its historical daily average volume of 26.55 million shares. This drop in volume indicates a temporary cooling of retail enthusiasm, leaving the stock price highly vulnerable to institutional sell orders and short-selling pressure. When a stock lacks heavy trading volume, even a small cluster of liquidations can cause the price to slide, which is exactly what we observed during the latest 4% drop. This recent downward drift is particularly interesting when you contrast it with the company's first quarter earnings report for 2026. On paper, Datavault AI Inc. actually beat the consensus Wall Street expectations for its earnings per share, reporting a loss of negative 0.09 USD compared to the negative 0.14 USD that analysts had predicted. Yet instead of triggering a massive wave of buying, the market threw a tantrum, and the stock plummeted by more than 14% immediately following the announcement, dropping down to the 50-cent mark before sliding even further to its current sub-40-cent level.
This sharp sell-off occurred because the market looked past the slight earnings per share beat and focused entirely on the company's precarious financial position. Even though they reported a quarterly revenue of $3.42 million USD and maintained that their full-year revenue target remains at $200 million USD, the market is deeply skeptical about how they will actually achieve that back-half-weighted growth without massive share printings. The core problem that big institutional funds are looking at is the ongoing capital consumption rate. The company's operating expenses for the quarter ballooned significantly, driven by heavy spending on research and development alongside massive selling, general, and administrative costs. To keep going, the firm has had to rely on private placements and continuous warrant issuances to maintain its $250 million USD liquidity buffer. Every single time a company relies on private placements to secure working capital, it places a heavy weight on the existing retail shares. Professional traders using advanced execution setups on an Interactive Brokers platform or analyzing deep book data via Interactive Brokers trading tools can see the institutional short interest building up as a hedge against this impending dilution. They understand that microcap companies often operate like a treadmill, where new shares must be constantly generated just to fund current operational liabilities. For the everyday participant managing an individual brokerage account, these complex capital adjustments can be difficult to track in real time. If you look at the user distributions across popular retail investing platforms, a huge portion of the small cap volume flows through the Robinhood app and similar digital interfaces. Younger traders often utilize Robinhood stock trading for its simplicity, buying up fractional shares or dipping into Robinhood crypto allocations without fully reading the SEC Form 8K filings that detail toxic financing structures. While Robinhood investments and features like Robinhood Cash Management make it incredibly easy to move capital around, they don't protect an individual from the fundamental risks of holding a company whose primary financial survival mechanism is issuing massive amounts of new equity to third-party institutions. To understand exactly why Datavault AI Inc. is in this position, we have to look briefly at what this business actually does and where it came from. The company was originally known as WISA Technologies, a business focused on spatial audio and semiconductor solutions for wireless sound systems. In February of 2025, the corporate leadership decided to change the name to Datavault AI Inc. to reflect a major pivot toward tokenomics, cloud data infrastructure, and specialized asset monetization models. Today, their primary business model revolves around trying to monetize secure data assets and expanding their proprietary Sanctum AI infrastructure across a planned 100-city footprint. They have also been trying to patch together an ecosystem by acquiring distressed or specialized entities, such as their recent integrations of the advertising technology firm Nayax and the cybersecurity business Cybercatch. This brings us right back to the central conflict between expectation and reality. The public expectation is that this business pivot will quickly transform an old audio technology company into a high-margin software enterprise. The reality is that integrating multiple distinct acquisitions while simultaneously deploying a complex infrastructure network requires an immense amount of cash, flawless execution, and a favorable regulatory environment. The corporate leadership has openly admitted that their future success relies heavily on the passage of pending federal legislation, specifically the Clarity Act, to provide a clear regulatory framework for their tokenomics business. Relying on government legislation as a primary business catalyst is an incredibly risky bet for any small-cap company, as political gridlock can easily delay approvals for years, leaving the firm stranded with high operating costs and dwindling cash reserves. When you look at your own portfolio strategy, whether you are utilizing a specialized Fidelity trading platform, executing orders via a Fidelity mobile app, or relying on classic Fidelity investments for long-term wealth building, assets like this require an entirely different set of rules. A conservative portfolio built around Fidelity ETFs, Fidelity mutual funds, or stable retirement assets within Fidelity IRAs has almost no exposure to these sub-$1 microcaps because the statistical probability of long-term survival is highly uncertain. For active traders who want to allocate a tiny fraction of speculative capital to these types of plays, doing so through a dedicated self-investing account on a platform with low Interactive Brokers fees or using targeted SoFi active investing accounts might make sense, provided they have a strict exit strategy. Comment below how many shares of Datavault AI Inc. you currently hold, or if you prefer sticking to large-cap tech companies instead. Looking ahead at the future outlook for Datavault AI Inc., there are a few distinct scenarios that could unfold over the coming quarters. The best-case scenario for the bulls relies on the company successfully delivering on its back-half-weighted revenue guidance of $200 million USD for the full year of 2026. If the commercial rollout of the Sanctum AI network gains rapid traction in its initial target cities, and if the revenue from the Nayax and Cybercatch integrations begins to scale efficiently, the company could potentially achieve a path toward positive cash flow. If that happens alongside a favorable legislative breakthrough with the Clarity Act, the stock could experience a massive short squeeze, rewarding patient, high-risk investors who bought shares at these depressed levels. The alternative scenario, which the current market trend seems to be pricing in, is a continuation of the dilutive cycle. If the commercial adoption of their data platform moves slower than expected, the company will have to continue tapping its shelf registration statements to raise capital. Each new warrant issuance, like the one just delivered to Maxim Group LLC, dilutes the current equity pool, making it harder for the stock price to sustain any meaningful upward momentum. For retail investors utilizing accounts across various investing sites, from a standard SoFi investing profile to an advanced individual brokerage setup, the key lesson here is that a low stock price alone does not make a company cheap. To summarize our central insights, Datavault AI Inc. represents a classic case where the market narrative of technology expansion is clashing directly with the cold reality of corporate finance and capital dilution. The initial expectation of a quick, smooth turnaround following the name change has been challenged by heavy research expenditures, post-acquisition integration hurdles, and a relentless need for external funding. While the company maintains an optimistic full-year forecast, the recent drop to $0.3895 and the lower-than-average trading volume suggest that the market is demanding concrete financial results rather than future promises. Navigating this stock requires looking past the superficial excitement of small-cap tech and keeping a very close watch on the underlying share structure and cash burn rate.